Welcome back to Global Marketing Day, New York, where we are live. And thank you, Clayton, for that presentation in San Francisco. So we've got a lot planned for you in this last session in New York. Our next session, our final session here in New York, features the insight of David Buttle, Global Commercial Marketing Director of the Financial Times. David leads on all advertising-facing marketing campaigns for the FT, where he's been for the last 5 years. Prior to this, he was head of commercial marketing, and before that, head of commercial marketing for EMEA. Now, joining David for our post-presentation discussion is Eugene Levin, Chief Strategy Officer at Semrush. Eugene was actually one of the very first investors to spot Semrush. After joining the company as Chief Strategy Officer, he helped to quadruple company revenue and raised over $40 million from Tier 1 investors. So let's jump into David's presentation, The Dying Art of Brand Building and How to Revive It. Take it away.
Thanks very much. And good afternoon, everyone. My name's David Buttle, as I was introduced, and I'm the FT's Global Marketing Director for Commercial. And it's great to be taking part in this, the first Global Marketing Day. I think it's a fantastic concept. So in the next sort of 15 to 20 minutes, I'm going to take you through the findings of a study which we unveiled in Cannes Lion this year, entitled The Board Brand Rift, and conducted in partnership with our friends at the IPA. This research goes into the leadership of businesses and to try and understand their attitudes towards brands and how these are changing over time. The report is based on a survey of 500 FT readers, and it's broadly representative of our readership as a whole. And this means that around 45% are C-suite, so board directors, and it covers the full range of business disciplines, with around 35% listing marketing, advertising, or PR as their core function. I believe that you'll all find not only the research interesting, but that it has significant consequences for the marketing industry and for business more widely. But first, why are we doing this? Now, this is a slightly reductive view, but advertising can be seen to serve two distinct functions in the operation of a business. It can support the revenue line for the current operating period by driving immediate sales, and predominantly this is achieved through performance or direct response activity. And secondly, it can protect and support the growth of future revenue streams. And this is achieved through brand building. And this typically delivers a result beyond the current operating period. And looking at this data on the screen now from Ender's analysis, we can see that over the last 15 years, there's been a marked shift in investment, from the latter to the former, from brand building to direct response, from long-term to short-term. With this study, we wanted to get inside businesses to understand why this is happening. And we look beyond the marketing department. This research explores how senior business leaders across various disciplines perceive brands and understand the mechanisms by which brands are built. So our research spanned 4 areas. I'll just talk you through these briefly. Firstly, belief in brands. We wanted to understand whether business leaders still believe that brands deliver a commercial value, and what are the fundamental business KPIs to which they contribute. Secondly, we wanted to understand who was setting the brand agenda and who was controlling the mechanisms by which brands are built and maintained. Thirdly, we wanted to understand how the degree to which business leaders understand brand building and understand the measures by which you can track the health of brands over time. And then finally, we wanted to explore the contribution of creativity and the degree to which creativity was perceived to deliver a commercial return. So just quickly here, we distilled those 4 areas down into 2 fundamental research objectives. You can see them on the screen now. I won't go into those in any great detail. There's also a little bit of information here on the survey sample. You can see it's truly global, slight skew towards the UK, but that's representative of our audience, as I said. Over 500 responses, so it's a pretty big survey of certainly when we're talking about business leaders this senior. And what I'll do now is I'll jump straight into the 10 key data points. Together, I think these 10 points paint a fairly comprehensive picture of what the study tells us, but I would encourage anyone to download the full version of the report as well. It's available on the IPA's website, and because there's certainly more detail and more nuance and richness in there. But anyway, I've pulled out 10 key points for today because of the time constraints that we're operating under. So firstly, some good news. 83% of business leaders either agree or strongly agree that brands deliver to the bottom line. Almost three quarters also claim to understand, that they know how they do that. That's the chart we've shown here. This group uses terminology around brands and considers brands to be assets that contribute to the financial strength of their business. When we asked about this in free text, it was clearly particularly salient in the context of M&A, where our respondents tell us that brands are explicitly considered. I don't think this is surprising, considering brands contribute a significant and indeed a growing proportion of overall enterprise value. We then dug a little deeper into how brands are perceived to deliver financial value. And I think broadly here the results are heartening as well. Brands are seen as important for a wide range of business objectives, and particularly those that relate to growth. However, we also asked what businesses were prioritising at the moment, and some of the top priorities that came through were things like resilience, profitability, and cash flow. And these things relate more to defensive strategies than to expansion. I think we probably only need to consider the political or macroeconomic climate to understand why that's likely to be the case. But these defensive objectives were not areas in which brands were perceived to play a crucial role. And I think this may be a contributing factor to that diminishing brand investment that we saw earlier. There's a clear call to action, I think, here for the marketing and media industry. If we believe that brands deliver defensive capabilities to businesses, and I certainly think they do, then we have to communicate that, supported by robust evidence. In turn, that should help create an internal environment in which marketing investment is freed for brand building and branding objectives. The third point, there's some more positive theoretical beliefs here. Business leaders overwhelmingly claim to appreciate that greater returns are delivered by a balanced approach to long and short-term marketing activity. There's a notable divergence here between marketers and non-marketers. Surprisingly, to me at least, marketers were more likely to agree that the board understands the commercial benefits of a balanced approach. One could read from this that the forces driving this short-termism that we're seeing aren't all coming from outside the marketing department. Shortening CMO tenure may have a role to play here. I suppose the fundamental question is, why invest in the creation of a brand and the resilience of future sales that come with that if you're not going to be in post to reap the rewards of that work? However, I think taken together, these first three slides indicate that there's a strong theoretical foundation from which to build the case for brand investment. Business leaders haven't forgotten about brands, or on the whole, what they have the potential to deliver in commercial terms. Now we go into the workings of how marketing is managed within businesses, and that's the second section of our research. Unsurprisingly, given the investment data described earlier, we're seeing a widespread shortening of marketing reporting cycles. This is a global phenomenon, shift is taking place the world over, but as you can see from this data, it's particularly acute in Asia Pacific. The verbatim responses to this question gave a little more depth as to what's going on beneath the surface here. Where respondents reported shortening cycles, it was almost always due to external forces, such as market changes or shareholder pressure. In contrast, where cycles were said to be lengthening, and there weren't that many cases of that, but where they were, it was always due to internal strategic reasons. The impetus came from inside. And I think this tells us that if businesses are going to be able to take a long-term view about their marketing objective setting, then that probably needs to come from within. And clearly marketers and their standing within the business is going to be crucial if that's going to be achieved. This shortening of reporting cycles could be a consequence of the lack of confidence we see amongst business leaders in their ability to create and maintain brands. 50% of business leaders perceive the knowledge of brand building in their boardroom to be average or worse. So 50% perceived the knowledge of brand building to be average or worse. So that's one of the key findings of the study, and I think it's fairly startling. I think what this starts to paint is a picture of a rift emerging between the board of a business and the brand, and that's hence the title of the report. This low confidence in brand building capabilities is even more troubling when seen in the context of this data. 70% of our respondents told us that objectives for long-term marketing strategy, so the realm in which brand building clearly sits, are determined by senior leadership. So this is the same group that confess in the previous slide to telling us they have at best a patchy understanding of the mechanisms by which brands are built. So I think logically it follows from this that where the understanding is weak, or at least the confidence isn't there, and the measurement of brands, as we know as marketers, is inherently complex, delayed, and somewhat ambiguous, the temptation will be to invest where measurement is clear and returns can be guaranteed, even if that's not going to maximise business performance over the long run, and the evidence tells us that it's not. This must be another contributing factor to the shift to shorter-term marketing investment. Again, there's a clearly actionable point here for the marketing industry. We need to express confidence in our ability to build brands. We need to review brand metrics at the highest levels in organisations. And we need to build familiarity with this craft. And confidence and investment should follow. However, this data suggests it may not be that simple. Troublingly, proficiency in the craft of brand building isn't much better inside marketing departments. 1/3 of senior marketers rated their understanding of brand building as average or worse. This study isn't longitudinal, we've only conducted it once, so we don't know how this has changed over time. But I would be amazed if this were the case 20 years ago, when the development and maintenance of brands was arguably the highest value function of a marketing department, and particularly a marketing department operating in a consumer sector. This lack of knowledge is undoubtedly going to have an impact on marketing investment trends. It's fundamental to human nature, if nothing else, that we have a preference for doing the things in which we're confident in our abilities to do, and there's clearly not the degree of confidence one would expect in this area. We also asked directly about impediments to brand building, and this exact point featured. 22% of respondents cited the lack of brand building skills in the marketing department as a barrier to a better balance between long and short-term marketing activity. This adds further weight to the evidence that the driving forces behind this short-termism are not all external to the CMO and their team. I think senior marketers need to examine their own skills and those of their team members. This survey suggests that many would do well to invest in professional development in this area. Despite this, by far the most frequently cited impediment was the lack of credible brand metrics. I think in many ways this can be taken as a positive finding. Both evidence of the commercial return of brands in a general sense and credible metrics to monitor the health of brands over time are more available now than they've ever been before. Wider promotion and distribution of them and to the right audiences should yield results and should, especially for those wanting to invest in that longer term activity. And here we can see the potential of educating leadership and on brands and how they're built. This chart compares the belief in the benefits of a balanced approach to long and short-term activity of two groups. On the left are those that confess to having a low level of brand understanding, and those on the right are those that claim to have a high level. As you can see, the correlation is stark. Where business leaders have confidence in their ability of themselves and their business to build brands, they believe that a balanced approach delivers returns. For the marketing profession, again, the call to action here is clear and reinforces that derived from earlier points in the presentation. We need to build understanding and confidence across the leadership of our companies. This needs to encompass both what brands do and the mechanisms by which they're built and maintained. However, I'm afraid it seems that there's probably quite some way to go. We also asked our respondents to select the channels they thought were most effective for brand building. And putting word of mouth to one side, the two that came out on top were social media and online display. Shockingly, well for me at least, over twice the number of respondents cited social media as did TV. I'm certain that most people listening to this don't need to be told about the limitations of one-to-one digital communications for building a collective, public understanding of what a business stands for. I I think rather the message here is that the education task that we face as a discipline is vast, and the starting point seems to be rather low. And finally, slide 10A, which I included for a couple of reasons. Firstly, because this is originally at Cannes and it's about creativity. And secondly, because it's a positive note on which to end a somewhat somber presentation. And this slide tells us that business leaders in general do understand that the quality of creativity in marketing communications links directly to commercial performance. And they're right to believe this. There's abundant evidence, and indeed we launched this study in Cannes with another study from the IPA which showed that creatively excellent cases are 8 times more effective in terms of their proven business results than lower performing creative cases. So there's abundant evidence there, and this is certainly a positive note on which to end the presentation. So just to wrap up before I take questions, taken as a whole, I think the picture we see emerging here is that of a gulf opening in business. Senior leaders continue to have faith in the power of brands notionally, and they're in control of the levers which impact the creation and maintenance of brands. However, to some extent they're flying blind. They don't have the metrics or the confidence to inform their decisions. Consequently, it seems they're not affording these crucial business assets the attention or investment they need. And I think the consequence of that is that businesses across a wide range of sectors are not performing to their commercial potential, and they're effectively leaving money on the table. I think it's upon us as a marketing industry to try and change that. Thanks for listening, and I'd be delighted to take some questions.
Excellent. Well, thank you, David, for that latest FT research. I think we've gotten a lot of high-level insights there, and especially as we move into 2020, there's a lot of attention being paid, I think, towards some bigger directional goals as it relates to the marketing industry at large. You know, it's been around for a long time, and innovation and investment are really under the microscope, I think, for a lot of companies. So, some questions. First question I'd like to ask for Eugene comes from our audience, and that question is, do you have advice on how to effectively handle objections from finance or how to build confidence in strategies that may not always have immediate results and get buy-in for brand building campaigns?
That's a good one. That's a good one. I would put it this way. You know, the role of finance in a company to help you make right decisions, because at the end of the day, business is more successful if it grows fast and more profitable. So finance wants this, you want this as well. Now, in most cases, finance teams, at least finance teams I used to work with, they want to challenge you, but if there is evidence, they will agree that long-term approach will deliver results eventually. But there have to be some evidence. So I guess the question is, instead of maybe pushing too hard and just saying, I'm right, I know this is going to work, collect some evidence on some scale, present it, and say, you know, we tried this on a small scale in one market, we invested in brand, we waited for 6 months, you see our, for example, conversion rate starting to grow. And we can correlate this with brand awareness. And then you can build a model and say, if we have the same results in other markets, this is how our business is going to look. And in most cases, you will have a sign-off. I mean, there are situations when companies are really distressed and they have cut to the bone. If there is if we're talking about healthy business, if there is any evidence that in the long run that will be better, finance teams would be always on your side.
You know, it is interesting how in the way that marketers have skills to understand their audience and they empathize with what the audience needs and give that to them, there is the same opportunity internally with stakeholders, right?
Yeah.
Speak the language of finance to give them what they want so that you get the budget that you want, right?
I think I think a lot of it boils down to language. I think speaking to an FD and asking for investment to grow awareness or salience is always going to be a difficult one. To your point, the greater the extent to which you can link brand metrics with commercial performance and create a clear sort of hierarchy there, that's going to make that case all the more compelling. If you just go in talking about, fluffy, from their perception, fluffy brand metrics, then you're probably not going to get very far. And I think language is key to that. And an appreciation of the perspective of finance, right? They're concerned about things like cash flow. Their entire perspective on the business is different from a marketing perspective, which is necessarily one of the customer, which is a healthy perspective, but it's radically different from a finance department.
Yeah, they are different. David, you mentioned that boards are not confident in brand management, and I'm curious what you think marketers can do better to solve for that. I know that's a really big question, but.
So what would I say? I mean, probably the thing that came through strongest in the research was around measurement, that exact piece around measurement. And even just having the conversation about the health of a brand at most senior levels, reviewing it on it, whether it's a quarterly basis or a monthly basis, but at board level, how is our brand? What PR stories have affected it? I think that was probably, if there was one thing I would say, it's about building some brand metrics, being able to track them over time and having those discussions at the very most senior levels in organizations. That would at least start to build some awareness of this. We have this asset. It needs it needs effort and it needs investment in order to maintain its value. That would be, if I was to say one thing, that would probably be it.
Do you think there's value in making comparisons to competitors in that way, where you can benchmark? Maybe you can benchmark how you're doing, how a competitor is doing, and then what the go-forward metrics and your progress maybe in comparison is.
I think certainly that will. There's a competitiveness there, isn't there, which appeals to some personalities, if nothing else. So I think absolutely, if you can say, well, we've been tracking our business versus our key competitor in this market over the course of the last 3 years, and actually their brand's been moving up and ours hasn't, then there's something on which to base a case for investment there. And I think the other point, and it's really just reinforcing what I said earlier, but it's brands are a financial mechanism. They deliver in a financial way. They sort of secure future sales through customer loyalty. They reduce the price sensitivity of your customers, which leads directly to margins. These mechanisms need to be surfaced within the business, and that's going to help that case as well.
A question for you, Eugene. Does it make sense to create a brand within a brand? So micro brands, sub brands. For example, this event has its own brand, but yet there's the company brand. When does that make sense?
So, I think in every situation, answer might be different. My approach is usually think about brand in a context of audience. So, if the new thing that you want to do has the same audience, then it's better to run the same brand. If, like in case of this event, audience might be much broader, then it makes sense to have separate brand. And we also doing sometimes brands that are smaller than Semrush brand. For example, we recently launched a company called Sellerly to help Amazon sellers. It's technically the same Semrush team working on it, but because we are targeting different audience that has some overlap with core audience, but not 100% overlap, we are trying to go through different brand that probably would better resonate with this target audience.
Okay.
But I would put audience first 100% of time and then think from audience point of view.
Okay. This is a question for both of you from our community. Both of you have extensive experience in marketing in the business world. So, drawing from that and your intelligence, what one marketing channel would you focus on to boost long-term brand building? I know there's a it depends. I know. There's it depends as part of that answer. But is there a gut feeling?
I mean, so if you think about the core components of a customer-based brand, a view of customer-based brand equity are awareness, associations, and perceptions of quality. And I think there's been a marked shift towards digital channels which are less effective at delivering against those than good old-fashioned linear TV, which is, has been proven to be incredibly effective at building brands. Outdoor, that's again, it builds a collective public understanding. So I mean, it depends in particular. I mean, it does depend, and you said it depends. But what I would say is that I think the marketing industry has a tendency to be allured by the new and the shiny at the expense of the effective but less sexy.
Yeah. My advice is, ask yourself what is good brand, what you're trying to achieve. So I would say for many, let's say average SaaS businesses, because we are running SaaS business, I know this. So B2B SaaS, in most cases, what you want from brand building exercises, I want to have people who interacted with my brand certain number of times, and at least one of those interactions was so meaningful they understood what I stand for, what's my message, what's my point. And then other don't necessarily have to be kind of that deep, but number matters. So from this point of view, I think what David is referring to, once people know that Coca-Cola is tasty and sweet, then it's numbers game. I just need to be there as many times as I should to stay top of the mind. Okay. But that would be helpful only once message is delivered, I think. So in terms of practical advice, focus on delivering the message. So have a lot of materials that are kind of in consideration stage. So tell them what you actually want them to know, and then after that, do a lot of kind of high velocity, but not so much engagement time marketing. That can be advertising, but technically, once they understand, you just want to stay top of their mind. To make sure that when they have a problem, they go into to someone else.
So you're the first choice, the top of mind. Got it. This has been really insightful. This is great. Thank you very much for your presentation, David, and Eugene for your insights. Again, formal thanks to David Buttle, Global Commercial Marketing Director of the Financial Times, and to Eugene Levin, the Chief Strategy Officer of Semrush. So for those of you watching, I encourage you again to please connect with us on Twitter and make sure that you post questions, observations, insights, and even advice at Global Marketing Day, the hashtag. You can also connect with us at globalmarketingday.com. So I feel compelled to share some statistics with you. Let's see here. We have had some amazing numbers. More than 15,000 people have already watched us live. Over 5,000 tweets have been posted. And there have been over 1.2 million organic impressions on Twitter alone as a result of this event. So thank you guys so much for helping to make that happen. This has been a really good experience, I think, for everyone. So that's it for us in New York. I appreciate everyone chiming in. And now we're going off to San Francisco.